Afternoon, my people. What is going on, Wild Nation? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. I want to welcome each and every one of you to episode 141, Are Financial Advisors Necessary? But before we get into that, you know, I got to practice the attitude of gratitude and say thank you to each and every one of you who are here with me as I stream live across the Facebook Wealth Our Way page and the YouTube Wealth Our Way network page. Please subscribe to the YouTube page. And I also want to give the Wild Nation salute to all the members of Wild Nation who watch this program pre-recorded overnight, over the weekend, wherever they can squeeze 15 minutes of financial literacy in. And then a heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. So happy Thursday, everybody. You know, this is our weekend over here at 15 Minutes of Finance. We're not going to see you again until Tuesday. So I hope you guys all have a blessed and safe and enjoyable weekend. How about Carl Seaton last night? Yo, this cat just came and blessed us. Humble Hollywood-based guy. He's not a Hollywood guy. He's a Hollywood-based guy. Humble, brilliant, charismatic, intellect through the roof. Like, this guy is amazing. I love having him as a client. I love growing the friendship that we're having. And just kudos to you, Carl, for coming through last night and blessing us. And I hope you guys all enjoyed last night's episode of Snowfall. So yesterday, I came across an article, I think it was in Smart Money, talking about 7 tips of why a financial advisor is needed. So I perused through the article and I didn't think all of it was great. I didn't think all of it was bad. One thing jumped off the page at me, though, and it was a study that was performed by the good folks over at Vanguard. Shout out to the good folks at Vanguard. The study says, and I'm going to read my notes so I don't mess this up. The study said that Vanguard did a study on many different investors. They took investors that had the ability to invest $500,000. Now, why is this important? Because a couple things. Most people, when they work their entire life, will amass through their 401k if they're contributing regularly. They'll get close to that $500,000, if not higher mark. And most brokerage firms or investment advisors don't want to deal with you unless you have $500,000. So they were studying cats that had a $500,000 portfolio. And what they found was that over a 25-year period, if you worked with an investment advisor, your $500,000 grew to $3.4 million. If you did not work with an investment advisor, your $500,000 investment grew to $1.69 million. It's a difference of about $1.7 million. It's double, basically. So when people tell you that investment advisors aren't worth the money, bad investment advisors aren't worth the money, bad financial advisors aren't worth the money, but anything that is worth doing is worth doing correctly. And more often than not, a professional can help you. Now, here's the problem, and I see it every day because I'm on social media, I'm on the internet. I do this live for you guys on the internet. There are a lot of people out there calling themselves experts who are not experts. I see all of these classes being sold $4,000, $5,000, $6,000. It breaks my heart. Most of the people who would buy these classes don't have the money even invested to merit paying somebody $5,000 to teach them how to invest. The reality is that investing in general is actually a simple concept. I talk about it here all the time on 15 Minutes of Finance. Find out what your risk tolerance is. Find out what you can tolerate, because that will dictate whether you follow anybody's advice. If you are not used to taking a bunch of risk and you see your money go down 30%, you're going to leave the plan. You're not going to stick with it. So find out what your risk tolerance is. Find out what your investment objective is. Why are you investing? Is it for retirement? Is it a shorter term goal, college education for a kid, buying a house? What is your objective? And then the third leg of that stool is, what is your time horizon? I told you guys last week last month, I had a client call me up because she had a dream. And in the dream, Jesus told her to sell all of her investments. And, the market was doing really, really bad in January. So it freaked everybody out. At one point, the market was down, while I on live TV wiped my brow. So the market was down, I think, 11% at one point in January. Now, if we didn't panic, what's the market down year to date now? About 4%. So we've come back a great deal. If we did what Big Tank tells you and dollar cost averaged in, we had some really good buying opportunities in January. But anyway, Jesus told my client to sell her entire investment portfolio. And it was a big deal for her and her husband to have to get through this situation. And I helped as best I could. But the husband said something, wife didn't care. So, it's a matter of risk tolerance butting up against time horizon. The husband said, I'm not retiring for 16 years. Whatever happens right now, 16 years later, it will be back at least to what it is now. It will most likely be substantially more. So I don't feel as though we need to make a move right now. But, everybody's situation is different. The other part of making sure you're investing correctly is having a plan written out. All of my clients get an investment policy statement. They also get an asset allocation statement. It tells them where their money should be invested and how it should look at certain checkpoints. And then we compare it against the benchmark. And then lastly, I believe in a dollar cost averaging strategy, which if you have a 401k or a 403b at work, you are already dollar cost averaging, which means putting a set amount of money in at a predetermined time interval into a pre-selected investment or portfolio of investments. And in doing that, you are buying on the dips more and less when it's higher. And over time, you are averaging down your cost of your investment. And if you lower your cost when you sell later, you have a bigger margin of profit. So that's the simple side of investing. You don't really need an advisor after that stuff has been set up for you, except for one major thing. And this is why advisors will always be necessary. You could have that great plan that I just told you about. You could walk out your advisor's office and be all set. Then Jesus will come to you in your dream, or Allah or Yahweh will come to you in your dream and tell you, forget that plan. You should do this. This is the reason people go to therapists. This is the reason people get coaches. This is the reason people get trainers. It's not so much what they're telling you or teaching you or showing you. It's that you actually take action on what they're saying. A good financial advisor is like a captain of a ship. He always or she always makes sure that the ship stays on track. So I do believe financial advisors are necessary. I believe financial advisors are worth their cost because there's so many elements in a portfolio that could harm you. I have clients who were paying expenses inside their portfolio near 2% a year. Now working with me, they pay 30, 40 basis points, which is about 40% of 1%. A basis point, 100 basis points makes up 1%. So when you hear me say basis points, it's a fraction of a percent. So now they're paying 30 or 40 basis points as opposed to 2%, which is 200 basis points. That difference of 1.6% on $1 million portfolio is $16,000 a year. Saving that money year in and year out and having a portfolio that performs just as well as the one they were paying 2% for puts a lot more money in their pocket. Tax strategies, something very simple. Let's say that you have an asset allocation at 70% stocks, 30% bonds. Well, bonds tend to pay what's called dividends. Bonds pay interest. Bond funds pay dividends. Bond funds pay interest. So you will get taxed at your ordinary tax rate on these dividends, on the interest. Even if you're buying whole bonds, most people don't buy individual bonds, but if you do, it has a stated interest rate. It'll pay you the interest, except for if it's a discount bond. It's a whole nother topic. We'll get into that another show. When you're getting this interest, it's taxable right now. So just something as simple as putting your bond funds or your bonds in your tax-deferred, tax-advantaged accounts and putting your stocks or stock funds in your taxable account can save you a lot of money in taxes every year. That's something that your financial advisor is helpful to do. Also, and this is the most important thing of all of this, and I should have started with this first, a good financial advisor is a holistic advisor. They just don't help you with investments. They help you with all your finances, like a financial planner, like a financial planning firm like Wealth Our Way. We help you with all aspects. You have $100. You got a credit card that's charging you 20% interest, or you have a choice to put it into your Roth IRA. I go with the credit card at 20% because most investments that I would help my clients choose from aren't returning on average 20% a year. So the best use of a dollar, you guys remember Bud from my book, The 5 Money Must Do's and 3 Major Money Moves, or that's the other way around, my own title, my own book. So the reality is that best use of a dollar is to pay that higher interest credit card before trying to seek out 8, 9, 10% returns. So a financial advisor helps you do that. The last thing that I'll touch on is they help you carve out how much money you should be investing in the first place. Do not get me started the number of times people have taken money, put it into an investment, and 4 months, 3 weeks, 2 hours later, oh, I need that to pay this bill. If you put money into something that you need to take back out to pay something, you put too much of your money in. You didn't budget properly and understand how much should have went into the investment. When you go to put money into investments, it's money you should never be looking to touch again until your time horizon that you pre-stated gets reached. So if it's money for retirement, you don't look to touch it until retirement. If it's money for a wedding, you don't touch it until the planning for the wedding starts. So with all that being said, financial advisors are very necessary. Finding the right financial advisor, not the easiest thing to do, but keep working with your boy Big Tank and Wealth Our Way, and we'll get to the bottom of that. I'm going to cut out a little early today. Today's a travel day for me. I'm about to get myself ready to get on a plane. So give me traveling mercies, prayers for that. With that being said, I want you to have an amazing weekend. I look forward to seeing you guys all here next Tuesday on 15 Minutes of Finance. We have an amazing month on the Financial Power Hour coming up. I will not let that cat out the bag yet, but I want you guys to always remember what I tell you each and every day. Wealth is not only for the wealthy.